We are on the next module in the derivatives series, forward commitments and contingent claim features and instruments. Long title. Let's look at our learning objective, what we want to walk away from this with. Define forward contracts, futures contracts, swaps, options. We have both calls and puts, and credit derivatives, and compare their basic characteristics. So this is a very beginning introduction to a number of different contracts. And contracts can be grouped into two broad categories. Those that are called commitments and those that are called contingencies. A commitment means both parties must do something at expiration date. At some future date, both parties are committed to do something. A contingency is one where the buyer of the derivative, the one that has the long position, has a choice. They can either take delivery of the underlying or say, no thank you, I'm good. And we will see that when we get to contingencies, because the buyer has a right, that has value, the buyer will pay the seller a premium up front for that right. With commitments, no money changes hands on day one. Commitments all have a specific contract size. You have to know exactly what you're contracting for, right? A specific underlying that is named, one or more exchanges of cash flow or underlyings on specific dates. Swaps are the ones that have more than one exchange of cash flows. Same with derivatives, they have one or more exchanges, more than one exchange of cash flows. But for the most part, forwards and futures are pretty much one exchange of cash flow or underlying at some future time. And they have an agreed on price. So here is a timeline. Here is you and me today. Here is some point in the future. We will agree today on the price over here at which we will trade the underlying. And since it is a forward price, we denote it by capital F. And we decided on that price today, F naught, for delivery at time t. This is t equals 0. This is t equals capital T, meaning that's the end of the line. So let's start with forwards. Forwards are a common name to use for a contract which is traded OTC, over the counter, in a dealer market. It's an OTC contract. When we get to futures, we will see, you know what, a futures contract sounds like a forward contract. And it is. The only difference is a futures contract is traded on an exchange. So futures contracts are forward contracts, but traded on an exchange. So they're all called forward contracts at the heart of it. OTC contracts, the buyer, which we denote as having the long position, the buyer will buy or take delivery of the underlying from the seller, who we say has a short position and is responsible for delivering the underlying, at some future date, at some agreed on price set at contract inception. If the underlying price increases, the buyer gains, the seller loses. So let's think about that for a minute. Let's see if we can see it in our head without having to look at equations and charts. Let's say, and here's a nice timeline, here we are today, and you want to sell me your car 6 months in the future, and I'm going to pay you 10 grand in the future, and we agree today that I'm going to give you $10,000. I am long because I would benefit from the value of the car increasing over that period of time. You are short because you would be hurt from an increase in the price. You would rather the price drop because of the car is only worth $6,000 in the future. Too bad, you can sell it to me for 10. You get 10. Too bad for me when I say that, not too bad for you. But let's say that your car in the future is worth $14,000 and not 10. Well, I only pay 10. You could have gotten 14 on the open market, but that's the deal, right? So if the underlying price increases from the time you enter into a forward contract to the time that delivery happens, the buyer gains. If the underlying price falls, the buyer loses. So you have this kind of payoff. Here is ST. This horizontal line is the price of the underlying. Here's the price that we agreed on. If the price of the underlying at expiration is higher, well, these are all the gains that belong to the buyer. If the price is lower, these are all the gains that belong to the seller. S is the spot price, capital T is the maturity. We've already introduced this notation. This is the forward price agreed on at time t equals 0. So if the underlying price at expiration, S capital T, is greater than the forward price agreed on at time equals 0, the buyer gains how much? The difference between the two prices, ST minus F naught. So to go back to our example here, if ST is $14,000, we agreed on $10,000, I gain $4,000 because what I can do is pay you 10 and immediately sell it in the market for 14. So I would gain that much. The seller, we just put brackets around it and put a negative sign. The seller loses that much. You will find that derivatives are what are called a zero-sum game. In other words, for you to make $1, I must lose $1. It doesn't come from anywhere else. If one side is up $10, the other side must be down $10. No wealth is created in the derivatives market. No wealth is created, only transferred. Nobody suddenly gets richer without anybody losing. For somebody to win in the derivatives market, it requires someone to lose. Because remember, these are all contracts between two parties. If one of the parties to the contract wins, that win must come at the expense of the other party to the contract. If, on the other hand, the spot price at expiration is less than the forward price, the buyer loses. The buyer loses the difference between the two, so you just subtract them, and that would be the loss for the buyer. The seller gains. All we do is we put brackets around it and stick a negative. If one side has a gain, the other side has to have a loss. So if this side has a loss, you stick a negative in front of a loss that turns it into a gain, and the seller gains. Forwards can be physically or cash settled. So we may agree on an underlying that just simply can't be delivered. So let's say that we agree on, let's say, the number of tornadoes in the Gulf of Mexico, and I've got a number of rigs out in the Gulf that are extracting oil or natural gas, and I want to protect myself from too many storms. So what I'm going to do is I'm going to go long on storms, and maybe we have a number like anything above 5 storms, I'll get paid so much money. Well, you can't deliver storms. The underlying can't be delivered, so it would be cash settled. And sometimes the underlying is something physical that can actually be delivered, like barrels of oil, ounces of gold, things like that. Futures. These are exchange-traded forwards. The difference between a forward and a future is not just that they are exchange traded. To be exchange traded, they have to be common. So they got to be standardized. So they'll have standard sizes. So if I'm interested in trading 1,000 barrels of oil, there is a futures contract called CL, which is based on West Texas Intermediate oil in the U.S., and it is 1,000 barrels of oil. And it has a specific expiration date. It has a standardized date that it expires on. Well, what if I want 26,350 barrels of oil and I want it specifically on March 28th? Well, I'm not going to get 26,350. Even 26 contracts only gets me to 26,000, and oil usually settles around the 15th, 16th, 17th of the month. I want it on the 28th. The standardization is not good enough for me. Then I would go into the dealer market and have a customized contract made just for me because I have a size that doesn't lend itself well to standardization, and I have a specific date that does not line up with the standard dates. F sub naught T, we said that was the forward price, also stands in for the futures price, because a futures is nothing more than a forward contract which is very standardized and traded on an exchange. We will see later on that we arrive at the forward price by taking the current spot price and just compounding it over time, continuously compounding it over time at a specific rate of interest called the cost of carry. What would it cost to carry the underlying to some future point? That's the price. Most people think that this future price or the futures price is some forecast about what the future price would be. It is not. It has nothing to do with any expectation of what the future price will be. It is just a mathematical result of an interest rate, of time, and the current spot rate. That's it. Another interesting thing about futures over forwards is they have daily settlement. In a forward contract, we enter into a contract today, time goes by, there's expiration, we trade cash. Or the underlying, I get the underlying and you get cash, but all exchanges happen at this point in time. With futures, because you're attracting a wider group of investors to keep it really safe, the contracts are settled up every day. So after the first day, if I'm in gains and you're in losses, money is taken out of your account and put into my account today. The contract still exists. It's just every day we're going to settle up. So this is called mark to market. You might see it just by MTM. That means that it is marked to market every day. If the buyer's in gains, money is taken from the seller's account and added to the buyer's account at the end of the trading day. And the clearinghouse, there is a clearinghouse for exchange traded forwards, for futures. The clearinghouse is the counterparty to all contracts. So let's say you're looking at oil and you're looking on your trading platform, and there'll be a bid and there'll be an ask, and let's say it's 100.97 to 101.14. And you decide to buy at 101.14. Well, somebody posted that offer. So there's somebody that was selling and you're buying. But it's not buyer to seller. It is buyer to clearinghouse, and it is clearinghouse to seller. The clearinghouse is counterparty to all transactions. Here, the clearinghouse has a short position because the buyer has a long position. Here, the clearinghouse has a long position because the buyer has a short position, short and long. The clearinghouse is flat in this particular respect. The clearinghouse cannot make nor lose money on this contract. The clearinghouse is there to guarantee performance to either side. And this is done through margin. Each side, the buyer and the seller, post a margin. This is called the initial margin. It's sort of like a contract performance bond. So you're going to post margin saying, I will perform my side on the mark to market because here's some money that you can take from. There's also something called a maintenance margin. So you'll post your initial margin, and let's say you start losing. Well, your margin starts dropping until you hit this line called the maintenance margin. This is a level below the initial margin that the account must have. Once you hit this margin, you then must bring your account back up to the initial margin. And if you keep losing, you hit this again, you must bring your account up. If you can't, the contract is closed on you. It's called a forced liquidation. So let's walk through an example of mark-to-market and margin calls, and we'll use one of the examples from the reading itself, and I'll just take it a little bit further than they do. So GC is the ticker for the gold futures contract. The underlying is 100 ounces of gold. At contract inception, the futures price is $17.9213. The contract calls for an initial margin of $49.50 and a maintenance margin of $44.50. So here's the buyer, here's the seller, here's the price, and we'll use little f at this point to represent the days that we're going through as opposed to just the initial contract price. So we have this initial contract price. That is our price no matter what happens. So all of these prices that you see here are the prices that the contract would be if you entered it that day. Doesn't matter what these are. This is our price, which means all losses and all gains will be set against that price. So they both post margin $49.50. On the day we entered the contract, it's $17.9213. Closes at $17.9713. It's up $5. Well, the underlying is for 100 ounces. The contract will be quoted per unit of the underlying. So, for instance, when we see CL and we see the price of oil is $101.56. That's per barrel, but the contract is for 1,000 barrels. So to figure out the value of the contract, you must multiply the two numbers. Okay, so this is up $5. $5 per ounce, but the contract is for 100 ounces. So the buyer is up $500. The seller is down $500. The money leaves the seller's account, goes to the clearinghouse. The clearinghouse then sends it to the buyer's account. So now the seller only has $44.50 in their account because they had $49.50 for initial margin, $500 gone, they're at $44.50, whereas the seller has $54.50. Well, now we've hit the maintenance margin of $44.50. There'll be what's called a margin call. And the amount that has to be put in is enough to bring it back up to the initial margin. This is called the variation margin. This happens to be $500. We're back at $49.50. We're ready to go again. Over the next day, we're down $10. That's $17.97 down to $17.87. Again, it's for 100 ounces, so there's $1,000. The long position lost $1,000 because the price dropped, but the short position gained $1,000. So they're now at $59.50. The buyer is now at $44.50. They have a margin call. They must bring their account back up to $49.50. So you can see that the clearinghouse, being both long and short, can never lose or gain from the price risk of the contract. And because they keep the both sides raising the amount of margin, every time they hit the maintenance margin, they have to raise initial margin, they'll always have enough money to meet whatever happens over the course of one day, unless it's a really, really big move in one day. But there'll always be enough. So the clearinghouse, I don't think, ever in its history has ever lost on anything because of that margin. If the margin call is not met, the contract is closed. That is called a forced liquidation. The clearinghouse guarantees the performance to both sides. So if it so happens that the seller says, I can no longer continue to perform, the seller is gone, the clearinghouse guarantees the contract performance to the other side. As volatility increases, so let's say we're watching gold and it's doing this, and suddenly it starts doing this. It starts really going crazy. Big moves per day. Volatility is increasing. The exchange, meaning the clearinghouse, will increase the initial margin requirements because these are such big moves. They will say $49.50 may not cover it for a day. It's not uncommon for margin requirements to double or even triple. As oil went past $80 into $90, and then the Ukraine war. I don't want to call it that. We'll call it the war in Eastern Europe. As that unfolded, the exchanges raised all the margin requirements on oil only because it became so volatile that it could move more in a day than what was posted as initial margin. So all contracts had to raise the amount of margin. Well, this costs money. So what happens to the volume of futures contracts when that happens? Volume drops. And there are fewer people in the market because it costs so much just to stake one futures contract. This is a good time to bring in the notion of price limits. Futures contracts have price limits. This is the maximum amount that they can move in one day. And since the clearinghouse is counterparty to all the contracts, it cannot have a situation in which the price moves so much it completely wipes out an initial margin all in one move. So contracts typically have daily price limits. These are called circuit breakers. So if this is the current price today, let's say that we're looking at a futures price and we observe it, there'll be a certain percentage up and a certain percentage down that price can move within a day. And this is called the upper limit. This is called the lower limit. And if the price runs to the upper limit, it stops. It cannot trade at a price higher than the upper limit. It is the price is referred to as being limit up, which means only trades at a lower price can occur. No trade can occur at a higher price than that. If the price drops, it'll hit some lower limit. It's said to be limit down, and only trades at higher prices can occur. And this is to have an orderly market. Because if you have something that is, if you don't have these circuit breakers, if the price gets too far, what's going to happen is the short side is going to have to cover their contract by buying a long offsetting position, which pushes the price higher, which forces more people who are short to buy long positions to offset, which pushes the price higher and higher and higher, and you have a disorderly market because now the price is not reflecting the fundamentals of the underlying. The price is reflecting the panic of the short positions having to get out. So by having a limit up process, it allows a nice orderly market where the short side can find a way out. if it trades at a lower price, or find an offsetting hedge somewhere else. Futures have the same linear payoff and profit profile as forwards. Remember, we saw forwards, they look like that. Futures, same thing. And they can also be physically or cash settled. So if we take CL, which is oil, you can physically settle that. Somebody who actually wants oil can say, no, I'll physically take that. Or you can close it out the day before delivery or on the final day of trading and it just be cash settled at that point because, well, you're flat. Something like ES, which is the futures contract for 50 times the S&P. It's called an E-mini. It's for 50 times the S&P index. Well, you can't deliver the index because there's a whole bunch of fractional shares in there and there's a whole bunch of shares. It would be really difficult to deliver the index. So those are purely cash settled. Let's move on to swaps. Two counterparties exchange a series of cash flows in the future. One leg is floating, and we say one leg, one side. One leg is floating, which will be tied to some short-term market reference rate. Whenever you see MRR anywhere, that's the market reference rate. It's a nice way to say whatever the reference rate is in your country, because LIBOR is gone, so we don't use LIBOR anymore. Every country has their own short-term bank rate or interbank rate. In the U.S., it's the secured overnight funding rate. The MRR is the SOFR, but MRR just means that it's some reference rate that is market determined that sets the floating rate. The other is fixed, either a fixed rate or is tied to a different asset or a different rate. So you can have a fixed for floating. You can have the rate tied to an equity index, so it would be called an equity swap. You can also have a floating for floating, which is not very common. The most common is one side is floating, one side is fixed. Okay, let's get a high-level visual as to what's going on in a swap. On one side, we're going to have a fixed rate payer, and on the other side, we have the floating rate payer. So the fixed rate payer pays the fixed rate to the other side, and the floating rate payer pays the floating rate to the fixed side. So from this perspective over here, this person is in a pay fixed, receive floating swap. They pay the fixed rate, they receive the floating rate, whereas this side over here, from their perspective, is in a pay floating, received fixed swap. NA is a notional amount. No money changes hands, only these interest payments change hands, but let's say the floating rate interest is 2% and the fixed rate interest is 3%. 2% of what, right? 2% of what? Well, that's what the notional amount is. So if the notional amount is 100 million, the floating rate payer will pay the fixed rate payer 2% of a million, and the other side will pay 3%. At the next reset date, if the floating rate is now 2.75%, the floating rate payer will pay 2.75% to the fixed rate payer. The fixed rate still only pays 3%. At the next contract reset date, if the floating rate is 3.25, well, look at this. Now the floating rate payer is paying more than than they're receiving on the fixed rate. The fixed rate never changes. The floating rate floats with wherever interest rates are going. On inception date, there's an agreement on what the rates are. You can't agree on what the floating rate will be. You can only agree on what the market reference rate is, and then on a reset date, you note what the market reference rate is, and that becomes the rate. But the fixed rate is agreed on up front. It is called the swap rate. You'll agree on the term and on the payment dates. The most common swap is quarterly. Interest payments are swapped quarterly. Now we have money flowing this way and you have money flowing this way. It doesn't make a lot of sense. On each date they're netted out and whoever owes is the only one who pays. Let's look at the different types of swaps that we have. Interest rate swaps are the most common. The plain vanilla interest rate swap specifically refers to a fixed for floating interest rate swap. So if you hear the term plain vanilla, that means there's nothing exciting about this. It is the common fixed for floating swap. So here's the pay fixed side, here's the pay floating side, here's the fixed rate times the notional amount. This is a 5-year swap with annual resets. Again, the fixed rate is called the swap rate. So 1, 2, 3, 4, 5 times you'll have at the beginning of the contract, you'll know exactly what these amounts are because you'll know what the notional amount is, you'll know what the fixed amount is. This whole top row can be filled in. The bottom row, we don't know what it is. But it's the market reference rate times the notional amount. Now on day 1, we note what the market reference rate is, and that is paid on this date. On this date, we note what the market reference is, and that becomes the market reference rate to pay on this date. Why do we look at the rate at the beginning of the term and not at the end of the term? Simple. Let's say you go to the bank today and you make a deposit. You come back and you take your money out. What interest rate did you get? Well, you were told here what interest rate you're going to get over this period of time. You don't go to a bank, deposit your money, and they say, well, you know what, come back in 30 days and we'll tell you what your interest rate was. You know up front, because your money earns interest based on whatever interest rate was quoted this day for that period of time, not what the interest rate is at the end of the period. That's why we observe interest rates at the beginning of the period. And these payments are netted out, so only one side pays the other side. At the very beginning, the notional principal is not exchanged. In currency swaps, we'll see that they are exchanged because we're exchanging currency specifically because I want the other currency. So they do have to be exchanged. But if we're in the same currency and we're just swapping interest rates, I got a fixed rate, you got a floating rate, let's swap. Then all we need is some notional amount. So it's used to determine the size of the payments. That's it. It's not actually exchanged on day 1. Day 0. Okay. A pay floating received fixed swap is got the same economic effect as being short a floating rate bond and long a fixed rate bond. So I want you to see that implicitly. If I buy a bond, what am I going to get? Let's say I buy a bond and it has a fixed coupon payment. What am I going to get? I'm going to receive that fixed coupon. So let's say the bond is for $1,000. You can think of that as the notional amount. I'm going to receive the fixed rate times the notional amount. Receive fixed, being long a fixed rate bond. Basically going to get a coupon. And if I'm short a floating rate bond on every payment date, I'm going to have to send the other side the payment because I'm the one who sold it. I shorted it to the other side. Well, there's no one behind it but me. I must make those payments. So I'm basically short the floating rate bond. Well, a floating rate bond has very low duration. A fixed rate bond has a higher level of duration. So if I'm short the floating rate bond and long the fixed rate bond, I am long something with high duration and I am short something with low duration, which means I have net positive duration. So if I have a portfolio of bonds and I want to add more interest rate risk to my portfolio, rather than buy more bonds, I can simply enter into a received fixed pay floating swap, and this will add positive duration to my portfolio without me having to buy any of the underlying bonds. So I can add duration to a portfolio with a received fixed swap. Well, then the opposite is true. If I want to avoid interest rate risk for a period of time, I can enter into the opposite, a pay fixed, receive floating. A pay fixed, receive floating swap will have negative duration. So if I have a portfolio with positive duration, I want to bring that duration down, I enter into a pay fixed, receive floating swap. On day 0, the floating leg will equal 100 whenever you have a floating rate bond, because the rate each cash flow will be discounted at its own rate. That's the whole idea behind a floating rate bond. On day 0, since we know what the first floating rate payment will be, you have a par bond. So the fixed rate is the coupon rate that results in a par bond given the structure of interest rates. So if we have interest rates over 5 years that look like this, we would say, well, all the cash flows will be discounted at these appropriate spot rates for these periods of time. We'll come up with a yield to maturity. That yield to maturity will be the coupon rate. And if the coupon rate and the yield to maturity are equal, you have a par bond. This is all stuff you should know very well from fixed income. So on day one, the floating leg equals the fixed leg, and no money changes hands on day one. Swaps may or may not include collateral. Swaps are OTC, by the way. These are not exchange traded. They are all over the counter. They may include collateral, depending on who the counterparties are, and they may involve a central counterparty. Since the 2008-2009 financial crisis, more and more derivatives are being forced to use central counterparties to lower counterparty risk and even post margin to lower counterparty risk. So they may or may not include collateral, which means margin. You have to post the margin, and may or may not include central counterparties, but more are starting to require that to happen. When we get to CDS, the credit default swap, all of them have become standardized. Even though they're over the counter, all of them have become standardized. All of them require a central counterparty because they can be extremely high risk to a system. Now, if you feel that, wait a minute, there's more to say, I know something about swaps, you're leaving a whole bunch out. This is really just to define what these things are. It's just an introduction to the terminology at a very high level. You will see more of these in the modules ahead. You'll see the valuation of all of these contracts at level 2. How do we value these contracts between the initial date and the settlement date, if we need a value for them? And then in level 3, how do we use these contracts to alter different risk exposures or to gain different risk exposures? So we use them in a portfolio management perspective. So here at level 1, we're really just introducing you to the language and the basic mechanics of all of these derivatives. Okay, moving on to contingent claims now. And in doing so, a new learning objective. Bottom of the screen here, determine the value at expiration and profit from a long or short position in a call or put option. The value and profit. When we did commitments, they were what are referred to as linear derivatives, so that the value and profit are the same thing. So at the end of the contract at time t, we could look at the value of the contract based on what we paid. We know what the value is. It's the difference between the ending price and what we paid. That's also the payoff or the profit, because they were free to enter into. Options have a cost. So the value of the option at expiration is one thing. The profit is our value less what we paid to get that contract. Contingent claims can be over-the-counter or exchange-traded derivatives. ETD is exchange-traded derivatives, OTC, over-the-counter. The most common contingent claim are options. The buyer, which is the long position, has a right to determine if delivery takes place. It is their right to determine. The buyer, when we say buyer of a long position, there are two types of options. There are calls and there are puts. You can buy a call and you can buy a put. You are considered long on both positions. There is a thinking that if I buy a put, I have a short position. You have a long position in the contract. Your long position benefits from the stock price falling. So when you're long a put, you are inherently short the underlying, but you are still long the contract. All have a specific underlying, a specific size, a specific price, and maturity date. So let's look at an example here. For options, the buyer pays the seller a premium. Options are not free to enter because the buyer is getting a right. Well, that has value. You get to determine what you want to do in the future after you see what the underlying price is. And you'll only exercise your right if you're going to make money. If you're not going to exercise your right. I'm sorry, that has value. You got to pay me money to get that done. So let's say the price of a call option is $5 at time 0. a strike price of $30. This is called the exercise or strike price. At expiration, the stock price is $40. This contract gives you the right, the long position, to buy the stock for $30, and the seller must deliver the stock for $30. So the buyer is going to exercise the call and pay $30 for the stock. So what is the value of the call on expiration? It is the difference between 40 and 30. ST minus X is 10. That's the value of the call on expiration date. The profit is the value minus the cost to get it done. So the profit is $5. The seller loses $5 because remember, the seller got paid $5. If the seller got paid $5 and the contract is worth 10 to the buyer, it's worth negative 10 to the seller. But the seller got $5 up front. So it is the cost or the premium minus the value of the contract. There's what the seller got up front, $5, but lost 10 on the contract, so it was down $5. What happens at $25? Well, who's going to pay $30 for something that they can buy in the market for $25? Nobody's going to do that. So the buyer does not exercise the call. What's the value of the call? The call is going to have zero value. No one's going to pay anything for a contract to buy something for $30 when you can buy it for $25. It's going to have zero. So what is the profit? It's the value minus the cost of the call. The buyer loses the whole premium. Now, what if this went to 20? What if this went to 15? What if this went to 10? The buyer only loses $5. That's the most the buyer can lose is $5. What about the seller? The seller got $5 for selling the call. The buyer's walking away from it. So the seller has no further obligation at this point. The value of the call is zero. So 5 minus 0, $5. Notice that for the buyer to make money, the seller would have to lose. And for the buyer losing money, the seller would make. Contingent claims are also a zero-sum game. No wealth is created, only transferred. This is true of all derivatives. Any derivative, no wealth in an economy is created with these bets, only transferred. So think about it like a hockey game or any sporting game where millions of people bet on the game with millions of other people. And then there's going to be an outcome. Well, one side's going to win, the other side's going to lose, but no new wealth is created. It's only transferred between everybody else. So an economy doesn't get richer because of derivatives existing. It's just some people say, I don't want this risk. I'm willing to transfer this risk to somebody else. Well, somebody else says, I would like to take on more risk, but I don't have the money to actually buy the underlying. That's what derivatives are for, make a more efficient market, but it doesn't make anybody wealthier. All right, let me clarify something from the last screen. I ended by saying it doesn't make anybody wealthier. It does. Some people, half the people will get wealthier. Those are the ones who win, and half the people will lose wealth. Those are the people who lose. When I say it doesn't make anyone wealthier, for a group as a whole, everybody that's a party to a derivative, the sum total of their wealth will not change. Okay. Options can be classified by type, European and American options, and it has nothing to do with geography. It has to do with the way they can be exercised. European options simply mean an option that can only be exercised at maturity. You can't exercise it before maturity. Typically, OTC options are European-style options. They can only be exercised at maturity. American options means anytime exercise, and these typically are exchange-traded options. It is just unfortunate that they're named European and American because you think, oh, well, it's Europe versus the U.S., right? And it's not. It has nothing to do with that. It has to do with exercising. Now, that doesn't mean that you can't trade in and out of a European-style option before maturity. You can. This is anytime trading. Anytime trading. It's exercise. It can only be exercised at maturity, but you can trade anytime. Let's look at calls and puts. A call option is a right to buy the underlying. A put option is the right to sell an underlying. So let's say here is the stock price. Here is a strike price above the stock price, and here is a strike price below the stock price. We'll put puts on this side, calls on this side. At X1, the call is in the money because you can buy it at X1. The price is up here. The option will have at least that much value. That is called intrinsic value. This option is referred to as being in the money, ITM. An option with a strike price equal to the stock price is referred to as being at the money, ATM. The difference between these two, the strike price and the stock price for an in-the-money option, is called the intrinsic value. It is just the stock price minus the strike price, the distance between these. The option will trade for at least its intrinsic value plus some component of time value. So if this was $45 here and this was $50, the option would be at least $5 plus some amount for time value. When we get to option valuation models, we'll see how that is incorporated in there. X2 is out of the money. And let's say that this is 55. Well, you'd never pay 55 for something that's trading at 50. It has no intrinsic value. It has time value only. Puts are the other way around. If a call is in the money, the put would be out of the money. Because you would never sell something for $45 if you can get 50 for it. So this is out of the money, this is at the money, this is in the money. Again, in the money, we'll trade for at least its intrinsic value. And the intrinsic value here is X2, the strike price minus the stock price. And in our example, it's $5. It'll trade for at least its intrinsic value plus some component of time value. We're really just introducing the language here: in the money, at the money, out of the money, calls and puts, intrinsic value, time value, just to give you an idea of the type of language we'll be using. The longer the time to maturity, the higher the time value component. And at expiration, time value equals 0 because there is no time. You're at expiration, there is no time left. It will be 0. So the call, subcapital T, the call at expiration will be equal to its intrinsic value only. So a call down here with a strike of X1, given these numbers, will be worth $5 only on expiration date. This one will be worth 0. This put will be worth $5 because you'll certainly put it to somebody for $55 rather than sell it for $50, and this put down here would be worth 0. Long puts, that means if you buy a put, you're long the put, it benefits when the stock price drops. So the long put is inherently short the stock. Long calls benefit when the stock price increases, so a long call is inherently long the underlying price. I know it can sound confusing. You think that, well, if I buy a put, am I not short? You're long the contract. You are long the contract because you have the right. Right? The buyer has the right, but you are inherently short the underlying. You're long the contract, short the underlying. Don't get confused between those two. Now, you can also sell a call, and you can also sell a put. Here you are short the call, here you are short the put. So it is your position on the option that determines your long and short position, not where you benefit from a move in the underlying in this respect. And we're going to see that is the same when we get to CDS, that when you're long the contract, you're actually short the underlying. Okay, on this screen, these are called payoff diagrams. Not profit diagrams, payoff diagrams. So we have a long call, we have a short call, we have a long put, and we have a short put. Let's get the language of the payoff diagram down, and after that you should be able to read what's going on all of these. We have a long call. So what happens when we buy a call? Well, we have to pay the call price. So right away we're going to be negative. Here is the strike price, and here is our break-even point. Our break-even point is the strike price plus what we paid for the call. So on the previous screen, when we bought an earlier screen, we said we bought a call option for $5. Let's say the strike price was $30. Well, for us to start making money, the stock price at expiration must be greater than $35. Because at 30, that is our strike price. At 31, well, our option has made $1, but it cost us $5 to get that done, so we lose $4. We'd still exercise the option because losing $4 is still better than losing $5, but our break-even point is the strike price plus what we paid for the call. There's our strike price, there's our break-even price, and anything above that is a gain. I want you to notice something particular about long calls. You have a limited loss. The most you can lose is what you paid for the option, but you do not have a limited gain. It can keep going up. That's the beautiful thing about a long call, is that if the stock goes the wrong way and you were wrong, you don't have to worry about it. Look, the most I can lose is what I paid. So if I wake up one morning and I find out that this company has to restate the last 4 years of financial statements because it was lying to shareholders and the stock goes from $30 to $10 overnight, doesn't matter. I don't lose $20. The most I can lose is what I paid for the call, but I'm not limited in how far I can earn on the upside. The trade-off is that I don't break even at 30. I can buy the stock at 30, and when it goes to 31, I make the $1. But if I buy an option with a strike at 30, it must get to 35. That's if I paid $5, of course. It must get to 35 before I start making money. Let's look at the put. Again, we're paying for the put, so anything above the stock price, we're going to lose our money, because a put means that we want to sell it. We'll sell it to somebody else at the strike price. Well, if the market price is way up here, why would we ever sell it for lower, right? What's our break even? Well, the stock price has to drop below the strike price by at least the amount that we paid for the put. So it's X minus P naught. So let's assume in this example, P naught was $5 and the strike price again was $30. The stock price would have to get to at least $25 on the way down before we start making money. At $25, we're definitely going to make somebody pay $30 for it. We're going to exercise the put and make somebody pay $30. It's at 25, we make $5, but it cost us $5 to get it done, so we just broke even. Notice again, when we're long the put here, we have a limited loss. So if we buy a put on a stock and the stock decides, no, it's going straight up and up and up and up and up, well, it's not like we were short the stock and we keep losing. We have a limited loss, but not a limited gain. It is limited by the zero line. Once it falls to zero, that's really about all you're going to make. But when we say it's not a limited gain, it's not limited by anything in the contract. Just the loss is limited. And the long side has counterparty risk, because the long side will either have an option that's worth zero or it's worth something, which means the other side will either owe it nothing or something. The long side can never owe the short side anything because you paid for the option up front. So no matter what happens, you can never end up in a situation where the long side has to pay the short side something. But the short side may have to pay the long side, so only the long side has counterparty risk. The seller either owes nothing or something. The seller has no counterparty risk because a payment like this, can never happen. Once the premium is paid, that's it. So let's have a look at the other side. If we have a limited loss over here, the seller has a limited gain. And if this starts moving upwards, then this has to start moving downwards. And there's the break-even point for the seller, which is the same as the break-even point for the buyer. And if you put these two things together, you will have a straight line, because you're above the line and you're below the line, so you'd be on the line all the way to this point. And for every dollar down, you're going every dollar up. You would have a straight line at zero. To measure the total wealth created from this contract would always just be zero. So take this and just flip it upside down and you'll have the short call. Take the long put, flip it upside down, and you'll have the short put. You'll have a payoff diagram for the short put. Limited gains on both, but you don't have limited losses. Now you may think, when would I ever want to sell a call or sell a put? Why would I ever put myself in a position where I can only make the gain, but my losses can continue to go on far beyond how much I could have gained? There are very powerful strategies in using options combined with the underlying that make the selling of options very, very desirable from an income perspective in a portfolio. So on their own, they look very risky, but once we start combining options with other options or with the underlying, we can create risk profiles that are lower than the original stock with an income stream that the underlying may not have. So they become very, very powerful. We don't really see a lot of interesting strategies really till level 3. And even at level 3, the strategies, are very basic strategies altogether. If you look on the site, you'll see an applied options course. That is if you really want to get into a lot of the more advanced things that options can do. Okay, credit derivatives. Notice we are back to our first learning objective here. This is based on the default risk of an issuer or a group of issuers. The credit default swap, CDS, is the most common credit derivative. It is a contingent claim. It's like an insurance contract. It takes a little while to get your head around what's going on, but I'll try to do it as slow as I can. Previous to 2008, 2009, CDSs were based on whatever the credit spread was of the issuer. So let's say that you were holding a corporate bond and it had a credit spread of 125 basis points, and you were worried that the credit quality would deteriorate. So you wanted to buy some insurance against that. You would enter into a CDS and you would note that the credit spread was 125 basis points. Since then, a lot of work has been done to try to standardize the CDS market. So they have standardized in terms of the premium rate. Investment grade corporate bonds have a CDS spread of 1%. High yield bonds have a CDS spread of 5%. This is the spread in the CDS. In other words, you enter into a CDS on an IG bond, it is for 1%. Well, what if the spread is only 80 basis points? And what if the spread is 120 basis points? Well, the difference between that and 100 basis points becomes what's called the upfront payment. And either the buyer of the CDS must give an upfront payment to the seller, or the seller must give an upfront payment to the buyer. Since the seller will be receiving premiums based on 100 basis points, if the true spread is 80, the buyer is going to overpay. So the seller must give the buyer an upfront payment. If it's 120 basis points, since they're only paying the seller based on 100 basis points, they'll be underpaying. The buyer must pay the seller an upfront payment. So this is different than an ordinary contract where forwards and futures were free to enter. Swaps on day one were set up so that both the fixed and the floating leg were equal to each other. The options required an upfront payment to be made. This is sort of a combination of the two. It's like a swap in the sense that there's going to be a series of payments being made, which is the premium, the 1% or the 5%. This is per year of whatever the notional amount is. But it also includes the option component of saying there has to be some upfront payment to correct from what actually is going on to the more standardized contract form. So, the credit protection buyer will pay regular premiums to the credit protection seller. Now, I want you to think about your car and your insurance company. You are a protection buyer. You're buying insurance on your car. And what do you do every year? You pay premiums to the seller, the insurance company that will insure your car in case something goes wrong. We'll change the word car to bond, and you have the same thing. You're insuring the credit spread of a bond. So if you buy a CDS, you're long the CDS contract, you are inherently short the credit quality of the company. So let's say that the credit spread is 100 basis points. And you say, I am worried about credit spreads widening. When the credit quality deteriorates, the credit spread gets bigger and bigger. So you're worried about the credit spread deteriorating. So you buy a CDS. And let's say the credit spread goes from 100 to 120. That means the credit quality of the company deteriorated. So that is why you are short the credit quality of the company by being long the CDS. Another way to say it is you're long the CDS, you are long the spread, and you benefit when the spread increases. From 100 to 120, the credit protection buyer would have a CDS that now has value. Because remember now, if it were 100, what's the upfront payment? 0. Well, now it's 120, right? So there'd be some payment involved in offsetting this one. Now the payments here, the 1% or the 5%, this is per year. Much like if I quote you insurance on your car at $1,500, that's $1,500 per year that you own it. And same with the high yield, 5% is 5% per year. And it's based on some notional amount. When you say 1%, 1% of what? Well, let's say I want to protect $20 million worth of bonds. And they're investment grade bonds. I can enter into a long credit default swap, pay premiums of 1%, and I'm protected from any downgrade in credit quality or any move down in credit quality, or the worst, a default altogether. The credit protection seller is short the CDS because you're selling the CDS. You're short the contract, and when you're short the contract, you are inherently long the credit quality. You're short the contract, which means you're short the spread. You want to see the spread go from 100 maybe down to 20. That would be great. But that means you're long the credit quality because the credit quality is improving. It may seem confusing at first, but when you work with them for a while, it just becomes second nature. If the issuer defaults, the seller covers the buyer's losses on the bonds. And when there is a default, these payments, they stop. Much like the insurance on your vehicle. If your vehicle gets stolen and driven off a cliff and it's destroyed, there are no more insurance premiums to pay because there's no car. It's over. You don't have to pay insurance on that car anymore. Same thing with the bond. Once it defaults, there is no more further payments to be made in terms of the premiums paid to the seller. What do we use CDSs for? It can be used to hedge existing credit risk, or you can take a directional view on credit spreads. You may have $20 million worth of bonds and say, I'm nervous. Well, then buy insurance. Or you may just note that there's a particular issuer out there and you say, you know what, that issuer is going to have trouble. Their credit spreads are going to widen. I don't have any bonds, but I know their credit spreads are going to widen. I know what I'm going to do. I'm going to take a long position in a CDS on that issuer. When we say the bond could be a corporate bond, the bond could be a sovereign bond, or it could be an index of either high yield or investment grade bonds, or it could be a special purpose vehicle. So the obvious question that is probably popping into some minds right now is, if this is a credit default swap, what's a sovereign doing in there? It doesn't have a credit spread. The credit default swap can earn money or lose money based on changes in a credit spread, but the bigger word here is default, credit default swap. When we use the word credits, we're typically referring to corporate bonds. So it can be confusing sometimes that a sovereign could be the underlying bond of a CDS, but it could be there for the default part of it, as opposed to any credit spread widening or shrinking, but for the default part of it. All right, let's walk through an exhibit. Time at t equals 0 at inception. You have a protection buyer and a protection seller. Over the course of the year, the buyer will pay the seller a premium. This is IG because it's 100 basis points per year. Typically, it's paid quarterly, so it would be 25 basis points per quarter times whatever the notional amount is. And the CDS is going to gain value when the credit spread widens, which is what we'll see at time t equals 1. Here we have another premium payment to be made, much like the insurance on your car is paid annually. The insurance here is paid annually. You pay it again. But this time, we note that the credit spread has widened. Instead of 100 basis points, it's now at 250 basis points. So the bond will have dropped in value because the credit spread widened. And because it widened, there's a gain to the buyer. So there'll be a mark-to-market gain to the buyer and a mark-to-market loss to the seller. And the change in the CDS price is roughly equal to the change in the CDS spread times whatever notional it was times effective duration. Don't worry too much about this. It's just kind of a look ahead. If you're looking at that saying, I don't quite get that, don't worry. Don't worry. It's coming up. You will know this. Don't worry. Right now, just, it's kind of just a look ahead. And now we have a credit event. A credit event means it is a default. By the way, there's a committee for the CDSs. A committee is set up to determine whether something is a credit event or not based on the contract of the bond, based on the trust deed of the bond. If they determine that there is a credit event, that's it. There is no CDS spread to be paid. That 100 basis points, notice that it's not being paid. There is a payment that the seller now owes the buyer, the insurance payout, which is the loss given default times the notional. So let's say that we put it in percent, the face value of the bond 100%, and let's say the recovery rate is 40%. That you can recover 40% of the bond because it has a claim against assets, right? That means you lose 60%. That is the loss given default. 60% times the notional, the seller must pay the buyer. So credit events, issuer default or failure to pay, the CDS contract terminates. It's the end of it, which means no more payments. The payment from the seller to the buyer, it says approximately equal to the loss given default times the notional. Once default occurs, called a credit event, the buyer stops paying the premiums. Very high level view. This is all we're doing at this point in time. So I know many of you probably are saying, but I don't get this, but I don't get that. As long as you understand this high level stuff right now, all of that other little stuff will fall into place as we continue on. So just have patience with your questions. They will be addressed as we continue on. And when I say we will address those questions as we continue on, I mean through the derivative section, not just this one reading. Last learning objective here, contrast forward commitments with contingent claims. And we're really just contrasting the payoff versus profit profile. For a linear derivative, we saw earlier in the beginning part of the video that the payoff is the profit because it cost us nothing to enter. But for an option, the value of the option is not the same as the profit on the option because we had to pay to get in. So the payoff of an option is not the same as the profit. You would have to take the payoff of the option minus what it cost you to get the option, then you'll get your profit. So they have different profit profiles. So this red line here is our forward profit. The green line is our option profit. This is a long forward versus a long call, and to buy the call, we had to pay the call price. That's the most we can lose. So as the price, here's ST, if it were this low or this low, notice that the linear derivative, the forward profit, would continue to lose money, but the option has a limited loss. The option will outperform the forward contract after the two lines cross. This is where you're indifferent between the option and the forward. Below that price, the option outperforms the forward contract, but the higher the price of the underlying at expiration, the forward profit will be greater than the option profit by the amount of the call price, whatever it costs to buy the call. Let's contrast a long forward with a short put. A short put, we're selling the put, so we get the premium. So the most we can make is P. So as the price goes up, look at the forward profit. It continues to grow, but the option profit stays flat. So the forward will outperform the option on the upside. On the downside, we're losing money both ways, right? We are short the put, which means as the price is dropping, we're going to start to lose money. But the forward will start to lose money as well. The option outperforms the forward. Why? Because we got paid something to take on that risk, whereas the forward contract, the seller of the forward contract, got paid nothing to take on the risk because they're free to enter. So on the downside, if you are wrong, the option payoff or the option profit outperforms the forward profit. However, if things work out in your favor, if you win on the contract, you could have done better in both cases by being long the forward contract. At a high level, that's it. We'll, as we go through this section, the modules coming up, start to look into this a little bit deeper.